George Soros made over $1 billion on a single trade in 1992. Ray Dalio built a $150 billion hedge fund by never letting any single position dominate his portfolio. Same macro brilliance, opposite execution. Let me show you why these two legends would never agree on how to bet. September 16, 1992. London. George Soros sits in his office at Quantum Fund headquarters. He's looking at a position ticket that would make most hedge fund managers physically ill. $10 billion, all of it betting against the British pound. Not diversified across 15 positions, not spread across multiple asset classes, not balanced for all economic seasons. $10 billion, one direction, one conviction, one massive, concentrated, career-defining bet. His chief strategist, Stanley Druckenmiller, had originally proposed a smaller position, maybe 200 million, 300 million, conservative, manageable. Soros looked at him and said, "This is a direct quote, go for the jugular." They went from a few hundred million to 10 billion, the entire fund leveraged in one trade. Now that same day, 3,000 miles away in Westport, Connecticut, Ray Dalio is running his morning risk analysis at Bridgewater Associates. He's looking at his portfolio: 30% stocks, 40% long-term bonds, 15% intermediate bonds, 7.5% gold, 7.5% commodities, 15 different positions, all carefully uncorrelated, all precisely weighted by risk contribution. If you told Ray Dalio that someone just put $10 billion into a single currency bet, he would think you were describing a gambling addiction, not an investment strategy. 1 month later, Soros walks away with over $1 billion in profit. They call it Black Wednesday, the trade that broke the Bank of England, the most famous currency trade in history. And Ray Dalio, he's still building his all-weather portfolio, one systematic rebalancing at a time, still preaching diversification, still saying concentration is the enemy of survival. Two of the greatest macro investors who ever lived, both understood economic cycles better than almost anyone, both built billion-dollar fortunes, both saw things other people missed. And they would absolutely never, ever agree on how to actually bet on what they saw. I'm obsessed with this contrast, like genuinely obsessed, because when you dig into the philosophies of Ray Dalio and George Soros, you realize something wild. These aren't just two different investment strategies. These are two fundamentally incompatible worldviews about how to operate in financial markets, and both of them worked. Both of them made billions. Both of them have been proven right over decades. Which means the question isn't who's right and who's wrong. The question is, why are they both right, and what does that tell us about how markets actually work? Let me start by laying out what Ray Dalio believes at his core. I've spent probably 100 hours reading his stuff, from the Principles book published in 2017 to old Bridgewater client letters from the 1990s, and his philosophy comes down to one unshakable conviction. Diversification is the only free lunch in investing. That's not just a cute phrase, that's the foundation of everything he's built. Dalio's argument goes like this: you can't predict the future. Nobody can, not consistently, not reliably. You might get lucky once, twice, maybe even 10 times. But over a long enough timeline, prediction fails. So if you can't predict and you build your strategy around prediction, you're building on sand, you're gambling. His solution: don't predict. Instead, build a portfolio that works in every possible economic environment. He calls them the 4 economic seasons: rising growth with rising inflation, rising growth with falling inflation, falling growth with rising inflation, falling growth with falling inflation, boom, Goldilocks, stagflation, deflation, 4 quadrants. And here's the key: each asset class performs differently in each quadrant. Stocks love rising growth with falling inflation. That's the Goldilocks scenario. Tech booms, markets soar, everybody's happy, but stocks absolutely hate falling growth. Recession, stocks crater, deflation, even worse. Bonds, though, bonds love falling growth. When the economy slows down, central banks cut rates, bond prices rise. Deflation is a bond investor's dream, but bonds get destroyed in rising inflation. Your fixed payments become worthless as prices rise. Gold doesn't care about growth at all. Gold cares about currency devaluation, rising inflation, especially with falling growth, that stagflation quadrant, gold shines. But in Goldilocks periods with strong growth and low inflation, gold just sits there doing nothing. So Dalio's insight was this. If you hold all of them weighted by their risk contribution, not their dollar amount, you create a portfolio that works no matter which season you're in. 30% stocks, 40% long-term bonds, 15% intermediate bonds, 7.5% gold, 7.5% commodities. The all-weather portfolio. And it works. The historical returns, 7 to 8% annually with way lower volatility than a stock-only portfolio. During 2008, when the S&P 500 crashed 37%, his pure alpha fund was up 14%, not because he predicted the crash, because he was systematically diversified across uncorrelated assets. This is where Dalio draws his line in the sand. He requires minimum 15 uncorrelated bets in any portfolio, not 15 stocks, 15 truly uncorrelated positions, because 15 stocks are all the same bet, they're all equities, they all move together when crisis hits. In 2008, it didn't matter if you owned Apple or Exxon or JP Morgan, they all crashed, correlation went to 1.0. But stocks, bonds, gold, and commodities, those are actually different bets. When one zigs, another zags, that's real diversification. And here's what Dalio would say about concentration. Concentration to him is the enemy. It's ego disguised as conviction. It's prediction disguised as analysis. It's gambling disguised as investing. He's seen too many smart people blow up by being right about the macro picture but wrong about the timing or the magnitude or the second-order effects. He lived through this personally. In 1982, Dalio predicted a depression. He was absolutely certain. He'd studied debt cycles going back 100 years. Mexico had just defaulted. The pattern was clear, depression coming. He told his clients. He positioned for it. He went on national television and declared it. And he was catastrophically wrong. The market rallied hard. His fund nearly went bankrupt. He had to borrow $4,000 from his father just to keep the doors open. That failure, that concentrated conviction bet, almost destroyed him. So he built a system specifically designed to make sure he could never be destroyed by being wrong again. Diversification isn't just a strategy for Dalio, it's a survival mechanism. It's the scar tissue from 1982 turned into a philosophy. Now let me tell you about George Soros, because Soros looks at everything I just said and thinks it's completely backwards. Soros doesn't believe diversification is a free lunch. Soros believes diversification is how you guarantee mediocrity. His whole philosophy, and this comes from his theory of reflexivity that he developed studying under Karl Popper at the London School of Economics, is that markets are not efficient. They're not rational. They're not even trying to find fair value. Markets, Soros says, are reflexive, meaning the participants' perceptions change the fundamentals, which change the perceptions, which change the fundamentals. It's a feedback loop. Reality and perception influence each other. Here's his classic example. A company's stock rises. That rise attracts attention. Attention brings new investors. New investors push the price higher. The higher price makes the company look successful. That success makes it easier to raise capital. The capital makes the company actually more successful, which justifies the higher price, which attracts more attention, round and round. Until something breaks the loop. And when it breaks hard, because the feedback works in reverse too. Price drops, confidence falls, capital flees, fundamentals deteriorate, price drops more. Soros's genius was recognizing these reflexive loops before they became obvious to everyone else. And when he spotted one, when he found a clear, powerful, unsustainable feedback loop, he didn't diversify into 15 different positions. He bet enormous amounts of money on the one asymmetric opportunity. The British pound trade is the perfect example. Let me walk you through how Soros saw it because this is important. In 1992, Britain was part of the European exchange rate mechanism. The ERM locked European currencies into fixed exchange rates with each other. The idea was it would stabilize trade and eventually lead to a single currency. But there was a problem. Germany had just reunified. East and West Germany merged. That's massively inflationary. So the Bundesbank, Germany's central bank, raised interest rates aggressively to fight inflation. Britain, meanwhile, was in a recession, high unemployment, weak growth. Normally, in a recession, you cut interest rates to stimulate the economy. But Britain couldn't cut rates because it was locked to the German mark. If British rates dropped while German rates rose, capital would flee Britain for higher returns in Germany. The pound would collapse. So Britain was stuck. Keep rates high, strangle your economy, try to defend the currency. Or cut rates, admit defeat, exit the ERM, let the pound devalue. Soros looked at this and saw the reflexive loop. The British government kept insisting they would defend the pound. We'll never devalue, we're committed to the ERM, trust us. But every time they said that, the market tested them. Currency traders would sell pounds, forcing the Bank of England to buy pounds to prop up the price. But Britain's foreign currency reserves were finite, and the market's capacity to sell was essentially infinite. Eventually, the reserves would run out. The government would have no choice but to devalue, and when they did, everyone who bet against the pound would make a fortune. This wasn't a prediction about whether Britain would devalue, it was a mathematical certainty. The only question was when, and what would happen to the pound when the dam broke. Soros didn't just bet against the pound, he bet $10 billion against the pound, his entire fund leveraged. Stanley Druckenmiller, his chief strategist, had originally proposed a much smaller position. Soros looked at the risk-reward and said, no, this isn't a modest opportunity. This is a once-in-a-decade asymmetric bet, go big or don't bother. On September 16, 1992, Black Wednesday, the Bank of England spent billions trying to defend the pound. They raised interest rates from 10% to 12% in a single morning, then to 15%. Didn't matter, the market kept selling. By evening, Britain announced it was exiting the ERM. The pound crashed. Soros walked away with over $1 billion in profit from one trade in one day. Now here's what I want you to understand. Dalio would look at that trade and see insanity. 10 billion in one position, one direction. What if you're wrong about the timing? What if the government finds some unexpected way to defend the currency? What if there's a geopolitical intervention you didn't see coming? You're risking everything on one outcome. But Soros would look at Dalio's all-weather portfolio and see timidity. You're spreading your bets so thin that you'll never capture the full upside of being right. Sure, you won't blow up, but you also won't make $1 billion in a single trade. You've optimized for not losing. Soros optimized for winning massively when he was right. Different philosophies, different risk tolerances, different definitions of what investing even means. Let me give you the mathematical difference. Dalio's risk parity approach says every position in your portfolio should contribute roughly equal risk. So if stocks are more volatile than bonds, you hold fewer stocks and more bonds to balance the risk. No single position can dominate. If any one bet goes to zero, your portfolio survives. Soros's approach says find the highest conviction, most asymmetric opportunity, and size that position according to the opportunity, not according to some predetermined risk allocation. If you're highly confident and the risk-reward is 10 to 1, you don't bet 2% of your portfolio. You bet 20, 30, maybe 50%, because the opportunity dictates the size. Dalio would say that's ego, you're overestimating your ability to see the future. Soros would say that's conviction. If you're not willing to bet big when you have an edge, you don't actually have an edge. Here's where it gets even more interesting. They both understand macro, like really understand it. Dalio's How the Economic Machine Works is one of the clearest explanations of debt cycles, productivity growth, and monetary policy I've ever seen. Soros's reflexivity theory predicted the 2008 financial crisis in his 2006 book, The Age of Fallibility. Same understanding, opposite implementation. Dalio says because macro is complex and unpredictable, diversify systematically. Remove yourself from the equation. Build a machine that works regardless of what you think will happen. Soros says because macro is reflexive and emotional, find the moments where perception has diverged so far from reality that a snapback is inevitable. Then bet everything on the snapback. And you know what's wild? They're both right. Dalio's pure alpha returned about 12% annually from 1991 to 2020. Consistent, reliable, low drawdowns. Soros's quantum fund returned about 30% annually from 1970 to 2000. Higher returns, higher volatility, occasional massive wins. Different paths, both successful. So what does this mean for you? Because I think this is where it gets practical. You're not managing a $150 billion hedge fund. You're probably not making $10 billion currency bets. But the philosophical question remains. Do you diversify like Dalio or concentrate like Soros? And I think the answer depends on what you're trying to accomplish and what kind of person you are. If your goal is wealth preservation, if you've already made money and you want to protect it, grow it steadily, and sleep well at night, Dalio's approach makes total sense. All-weather portfolio, systematic rebalancing, no concentrated bets, 7 to 8% annual returns with low volatility. Boring, reliable, safe. But if your goal is wealth creation, if you're starting with less and you need to compound faster, if you're willing to take on more risk for potentially much higher returns, Soros's approach becomes more interesting. Find asymmetric opportunities, concentrated conviction bets. Accept that you'll be wrong sometimes, but when you're right, you'll win big enough to more than compensate. The key is knowing which game you're playing. Dalio is playing the long game of compound consistency. Soros was playing the high-stakes game of asymmetric opportunity. Both won their games. Here's what I think most people get wrong. They try to do both. They diversify like Dalio, but then make concentrated bets like Soros when they feel confident. That's the worst of both worlds. You don't get Dalio's safety and you don't get Soros's upside. You get mediocre diversification with occasional blow-up risk. Pick a lane. If you're going Dalio, commit to the system. 15+ uncorrelated bets, systematic rebalancing, remove emotion, trust the math. If you're going Soros, commit to conviction, do the deep work to find truly asymmetric opportunities, size your bets according to edge, accept the volatility. But don't have to commit to both. Let me tell you what I took from studying both of them. Dalio taught me that you can build enormous wealth without ever making a hero trade. You can systemize, diversify, and compound your way to financial independence. You don't need to be a genius, you need to be disciplined. Soros taught me that concentrated conviction, when backed by deep understanding and asymmetric risk-reward, can create life-changing returns in short periods. But it requires an edge, real edge, not just confidence, not just a feeling, actual informational or analytical advantage. The danger is confusing the two, thinking you have Soros-level edge when you actually don't. That's how people blow up. They make concentrated bets with Dalio-level information. They risk everything on predictions they can't actually make. Or the opposite, having actual edge but diversifying it away because you're scared. That's leaving money on the table. If you genuinely see something the market doesn't and the risk-reward is heavily in your favor, putting 2% of your portfolio on it is underutilizing your advantage. Here's my framework. For core wealth, money you need for financial security, retirement, survival, Dalio's approach. Diversified, systematic, boring, reliable. For asymmetric opportunities, money you can afford to lose, where you have genuine edge, where risk-reward is 10 to 1 or better, consider Soros's approach. Concentrated, conviction-weighted, high-risk, high-reward. But keep them separate. Don't let your asymmetric bets contaminate your core wealth strategy. And don't let your diversification instinct kill your asymmetric upside. There's one more thing I want to talk about, the personality component. Because I genuinely think some people are built for Dalio's approach and some are built for Soros's, and you need to know which one you are. Dalio is a builder. He loves systems. He loves principles. He spent decades at Bridgewater developing documented decision-making processes, building idea meritocracy culture, creating algorithms to remove human bias. His meditation practice, 40 minutes every morning since 1968, is about emotional regulation and systematic thinking. If you love processes, if you're energized by optimization, if you want to remove emotion and build a machine that runs without you, you're temperamentally aligned with Dalio. Soros is a trader. He trusts his instincts. He reads markets emotionally. He talks about getting backaches when a position is wrong. Physical signals, gut feelings. Yes, he has theoretical frameworks like reflexivity, but his execution is discretionary, intuitive, human. If you're energized by reading situations, if you trust your pattern recognition, if you want to stay actively involved in every decision, you're temperamentally aligned with Soros. Neither is better. They're different, and trying to operate in a style that conflicts with your natural wiring is miserable. I've seen systematic thinkers try to be discretionary traders. They second-guess everything. They override their systems at the worst time. They destroy their own edge. And I've seen intuitive traders try to follow rigid rules. They feel handcuffed. They exit positions early. They miss opportunities because the system says no, but their instincts say yes. Know yourself, then pick the philosophy that matches. So here's what I want you to take away from this. Ray Dalio and George Soros both became billionaires by understanding macro better than almost anyone else, but they implemented that understanding in completely opposite ways. Dalio diversified into 15-plus uncorrelated positions and removed prediction from the equation. Soros made massive concentrated bets on asymmetric opportunities and trusted his conviction. Both worked, both made fortunes, both have decades of proven results. Which means the question isn't which approach is right. The question is which approach is right for you. What's your goal, wealth preservation or wealth creation? What's your temperament? Systematic or discretionary? What's your edge? Do you have genuine information advantage on specific opportunities, or are you better off trusting math and diversification? Answer those questions honestly, then commit to one philosophy. Don't try to be both Dalio and Soros. Pick your lane and drive fast. Now I want to hear from you. Are you more aligned with Dalio's systematic diversification or Soros's concentrated conviction? Have you ever made a concentrated bet that paid off huge, or blown up by not diversifying enough? Drop a comment below. I read every single one. If you found this valuable, hit that like button and subscribe. We're releasing new Ray Dalio deep dives regularly, and you don't want to miss them. I've got more comparisons coming, more investment philosophy breakdowns, more stories from legendary investors who built wealth in completely different ways. I'm your host, this is legendary investor, Ray Dalio, and I'll see you in the next one.